Hello and welcome back to the Forex course by Traders.money. I hope you found Lesson 1 insightful as we delved into the foundational concepts of the Forex market, exploring how it works, the different types of currency pairs, the key participants, the role of commodities, and getting hands-on with TradingView for analysis. Today, we're ready to take the next step in our journey. In Lesson 2, we'll dive deeper into more advanced topics that are crucial for becoming proficient in Forex trading. We'll cover how to read the chart, where we learn trends and market phases. Then we'll learn how to read the candles, technical analysis, trading psychology, which is very important, risk management and lots, choosing which pairs to trade, and much more. By the end of this lesson, you'll have a solid understanding of the essential concepts, setting you up for more informed and strategic trading decisions. Let's get started. In Forex trading, recognizing trends is one of the most fundamental skills you need. A trend is the general direction in which the market is moving, and understanding it can help you make better trading decisions. Let us first talk about the uptrend. An uptrend is characterized by a series of higher highs and higher lows. This indicates a general increase in price over time. Uptrends occur when buyers are in control, pushing prices higher. During this time, not opening short or sell orders is suggested. As you can see, in an uptrend, each successive peak is higher than the previous peak, and each successive trough is higher than the previous trough. This pattern shows that demand is outstripping supply, leading to rising prices. Traders often look to buy during uptrends, aiming to profit from the continuing rise in prices. A downtrend is the opposite of an uptrend. It is marked by a series of lower highs and lower lows. This indicates a general decrease in price over time. Downtrends occur when sellers are in control, pushing prices lower. In a downtrend, each successive peak is lower than the previous peak, and each successive trough is lower than the previous trough. This pattern shows that supply is outstripping demand, leading to falling prices. Traders often look to sell during downtrends to profit from the decline in prices and avoid long trades, buy orders, during this trend until the case of breakout, which we will learn later. Now you know when the market's overall direction in price is going upwards, it's called an uptrend. And when the overall direction of price is declining, it's called a downtrend. But wait, what if the overall trend of the market is neither an uptrend nor a downtrend? What if the price is just moving in one horizontal range? This right here, my friends, is called a sideways trend, also known as a horizontal trend. It occurs when the price moves within a horizontal range, showing no clear uptrend or downtrend. This indicates a period of market indecision or balance between supply and demand. During a sideways trend, prices move within a narrow range, forming a series of approximately equal highs and equal lows. This phase often occurs when the market is waiting for new information or when there is a balance between buyers and sellers. Traders may choose to wait for a breakout from the range before taking a position. Don't worry, I will soon tell you what a breakout is. Now, if your memory serves you well, you must remember where I taught you about trend lines in the last lesson. In this lesson, I will show you how you can use those trend lines to identify trends. So trend lines are a crucial tool for identifying and confirming trends. They help traders visualize the direction and strength of a trend. Now let's open up our TradingView and get the party started. All right, so here we have our TradingView opened, and here you can see on this chart that in this are the price is making higher highs and lower lows, so this right here is clearly an uptrend. We're going to take our trend line tool from the favorites panel. An uptrend line is drawn by connecting the lowest points of the trend, where this line acts as a support level. This line indicates where prices are likely to find buying interest. And now let's draw from this high point to the higher highs. These line doesn't need to be very precise. The trend can only become invalid in case of a breakout if we close a very healthy candle below the support line. Then that will be a breakout scenario. So let's do it one more time. Draw an uptrend line, start at the lowest low of the trend, and connect it to subsequent higher lows. Extend the line further to project future support levels. Do the same for the upside. Join the high with the higher highs and extend for future resistance levels. As long as the price stays above the trend line, the trend is considered intact. A break below the trend line could signal a potential breakout, resulting in trend reversal or period of consolidation. Now let's see how a trend line is drawn in a downtrend market. A downtrend line is drawn by connecting the highest points, peaks of the trend. This line acts as a resistance level, indicating where prices are likely to encounter selling pressure. Then we will be joining the lower lows, which will act as the trend support. Let's do it one more time for the sake of practice. Start at the highest high of the trend and connect it to subsequent lower highs. Extend the line to the right to project future resistance levels. As long as the price stays below the downtrend line, the trend is considered intact. A break above the trend line could signal a potential trend reversal, or maybe a period of consolidation like this. So now we will look at how to find and mark the sideways market. There's not much to do, so let's just get right in. So here we can see in this chart that the price is moving in the same area going up and down. So this right here will be our resistance. We will draw our trend line where all the highs are respected, like this. And we'll do the same for the support. Draw a line where all lows are respected. You can also use the rectangular tool to do this. So now we don't know where the market will go from here. So what we do is we wait for a breakout. A breakout will occur when the price will break outside the lines that we have drawn. Let's say that a very strong candle has breached either resistance or support. We will take the trade in that direction in case where the resistance is broken and the candle closes above this line, we will place a buy trade. And if the support is broken and the price is falling with a strong candle closing below, we will open a sell trade. All right, so we've seen how to find uptrends, downtrends, and sideways market. Now let's talk about the phases of the market. Let us begin. Now let us begin with accumulation phase. The accumulation phase occurs after a downtrend when the market consolidates at a lower price level. During this phase, informed investors, also known as smart money, start buying, anticipating a future uptrend. The accumulation phase is characterized by relatively low trading volume and narrow price movements. This phase represents a period of quiet buying by large investors who believe the market has reached a bottom. Prices are typically range-bound, moving sideways as buying pressure starts to outweigh selling pressure. Recognizing this phase can provide an early entry point before the trend changes direction. To understand the key characteristics of the is really important, so I suggest you to take notes of it. All right, so the accumulation phase is a critical concept in the study of market behavior, particularly within Forex trading and technical analysis. This phase signifies a period of consolidation following a significant downtrend, as we learned earlier, where savvy investors, often referred to as smart money, begin to accumulate positions in anticipation of an upcoming upward trend. Understanding the key characteristics of the accumulation phase can provide traders and investors with valuable insights into potential market reversals and optimal entry points. So the first thing is that the prices move within a tight range. One of the defining characteristics of the accumulation phase is that prices tend to move sideways. This period of price consolidation is marked by relatively stable price levels, with minimal volatility compared to the preceding downtrend. During this phase, the market is in a state of equilibrium where the forces of supply and demand are balanced. Buyers and sellers are in a standoff, resulting in prices fluctuating within a narrow band. The tight range of price movement can be visually identified on a chart as a horizontal or nearly horizontal pattern. This horizontal movement signifies that the intense selling pressure of the previous downtrend has abated, and the market is in a period of indecision. Investors observing this pattern can infer that the market is gathering strength for a potential breakout, usually in the upward direction, once the accumulation phase concludes. Volume may be lower than during the downtrend. Another hallmark of the accumulation phase is that trading volume is lower compared to the volume observed during the preceding downtrend. Volume is a critical indicator in technical analysis as it reflects the level of participation and interest in a particular asset. During the downtrend, high volume typically accompanies significant price declines, indicating strong selling pressure and widespread market participation. In contrast, the accumulation phase is characterized by relatively subdued trading activity. The lower volume indicates that the panic selling has diminished, and the market is transitioning into a phase where fewer participants are actively trading. However, it is important to note that the presence of smart money investors quietly building positions can still exert a significant influence on the market despite the overall lower volume. These informed investors take advantage of the depressed prices to accumulate large positions without drawing too much attention to their actions. Signs of increasing buying interest, higher lows, or bullish candlestick patterns. During the accumulation phase, subtle signs of increasing buying interest begin to emerge. One of the key indicators is the formation of higher lows on the price chart. Higher lows occur when each successive low is higher than the previous low, suggesting that buyers are gradually gaining control and are willing to purchase at higher prices. In addition to higher lows, traders often look for bullish candlestick patterns that indicate a shift in market sentiment from bearish to bullish. Examples of bullish candlestick patterns include the hammer, the bullish engulfing pattern, and the morning star. These patterns, when observed in conjunction with higher lows, provide further confirmation that buying interest is increasing and that the accumulation phase is likely progressing towards a breakout. Occurrence: after a prolonged downtrend or market crash. The accumulation phase typically follows a prolonged downtrend or a market crash. During such periods, asset prices often become significantly undervalued, presenting attractive opportunities for long-term investors. The extended period of declining prices results in widespread pessimism and often drives weaker hands out of the market, setting the stage for informed investors to step in. After a prolonged downtrend, market sentiment is generally bearish, and many market participants may be discouraged or hesitant to re-enter the market. This creates an ideal environment for accumulation, as smart money can quietly build positions without facing substantial competition. The transition from a prolonged downtrend to the accumulation phase marks the beginning of a potential trend reversal, where the market shifts from a bearish to a bullish outlook. Understanding the key characteristics of the accumulation phase is crucial for traders and investors aiming to capitalize on market reversals and trend changes. By identifying these features, market participants can make more informed decisions, positioning themselves advantageously for the subsequent markup phase and the potential for significant gains. Now, what happens after the accumulation is, as the investors flock into the market, this results in an uptrend or markup phase. Following accumulation, the market enters the markup phase, where prices begin to rise, leading to an uptrend. This phase often sees increased buying activity and higher highs and lows. During the markup phase, increased demand drives prices higher, and the market experiences higher trading volumes. Traders look for opportunities to buy during this phase, aiming to capitalize on the upward momentum. It's essential to confirm the uptrend with trend lines and other technical indicators. The key characteristics of the markup phase are clear higher highs and higher lows, increased trading volume, indicating strong buying interest, breakouts above resistance levels, positive market sentiment and news. So now you know that during the accumulation phase, the investors invest their money, which leads to the rise in price, which starts the uptrend or the markup phase. But what happens after that? Let me tell you what happens. After an uptrend, the distribution phase begins when the market consolidates at a higher price level, moving sideways. During this phase, informed investors start selling, anticipating a future downtrend. The distribution phase is characterized by relatively high trading volume and narrow price movements. This phase represents a period of quiet selling by large investors who believe the market has reached a top. Prices may move sideways as selling pressure starts to outweigh buying pressure. Recognizing this phase can provide an early exit point before the trend changes direction. Understanding and being able to identify accumulation and distribution phases is really important. Once you are able to identify these phases, you will be able to make profits easily, so let's get into the key characteristics of the distribution phase. So once again, the distribution phase is a crucial concept in market analysis, representing a period where informed investors, often referred to as smart money, begin to sell off their holdings after a sustained uptrend. This phase indicates a potential market reversal as buying momentum fades and selling pressure increases. Understanding the key characteristics of the distribution phase can help traders and investors identify optimal exit points and manage risks effectively. Prices move within a tight range at a high level. A defining characteristic of the distribution phase is that prices tend to move within a tight range at a relatively high level. This period of price consolidation occurs after a significant uptrend, where the market reaches a state of equilibrium with balanced buying and selling pressures. The narrow price range signifies a lack of strong directional movement as the previous upward momentum begins to stall. On a price chart, this tight range is typically seen as horizontal or nearly horizontal movement, indicating that the bullish trend has paused. During the distribution phase, investors and traders observe a period of indecision where prices fluctuate within a confined band. This consolidation period suggests that the market is assessing the current valuation levels and preparing for a potential change in direction. Volume may be higher than during the uptrend. Another key characteristic of the distribution phase is that trading volume often increases compared to the volume observed during the preceding uptrend. Volume is a critical indicator in technical analysis, reflecting the level of market participation and interest in a particular asset. During an uptrend, rising prices are generally accompanied by increasing volume, indicating strong buying interest. In the distribution phase, higher trading volume suggests that selling pressure is starting to build. Informed investors who accumulated positions during the earlier accumulation phase and the subsequent uptrend begin to liquidate their holdings. The increased volume reflects the transfer of assets from smart money to less informed participants who may not recognize the signs of a market top. This distribution of assets from stronger to weaker hands creates the foundation for a potential downward movement. Signs of increasing selling interest, lower highs, or bearish candlestick patterns. During the distribution phase, subtle signs of increasing selling interest begin to emerge. One of the key indicators is the formation of lower highs on the price chart. Lower highs occur when each successive high is lower than the previous high, indicating that sellers are gradually gaining control and are willing to accept lower prices. In addition to lower highs, traders often look for bearish candlestick patterns that signal a shift in market sentiment from bullish to bearish. Examples of bearish candlestick patterns include the shooting star, the bearish engulfing pattern, and the evening star. These patterns, when observed in conjunction with lower highs, provide further confirmation that selling interest is increasing and that the distribution phase is likely progressing towards a breakdown. Occurrence. After a prolonged uptrend or market rally, the distribution phase typically follows a prolonged uptrend or a market rally. During such periods, asset prices often become significantly overvalued, presenting attractive opportunities for informed investors to realize profits. The extended period of rising prices results in widespread optimism and often draws less experienced participants into the market, eager to capitalize on the upward momentum. After a prolonged uptrend, market sentiment is generally bullish, and many market participants may be overconfident or reluctant to sell. This creates an ideal environment for distribution, as smart money can quietly liquidate positions without facing substantial resistance. The transition from a prolonged uptrend to the distribution phase marks the beginning of a potential trend reversal, where the market shifts from a bullish to a bearish outlook. To conclude, understanding the key characteristics of the distribution phase is crucial for traders and investors aiming to manage risks and optimize exit strategies. By identifying these given features, market participants can make more informed decisions, protecting their gains and positioning themselves advantageously for the subsequent markdown phase and the challenges it may bring. Just as after the accumulation phase, the market reacts with an uptrend or a markup phase, after the breakout of the distribution phase, the sell-off occurs, which leads a downtrend or the markdown phase. Following distribution, the market enters the markdown phase, where prices begin to fall, leading to a downtrend. This phase often sees increased selling activity and lower highs and lows. During the markdown phase, increased supply drives prices lower, and the market experiences higher trading volumes. Traders look for opportunities to sell during this phase, aiming to capitalize on the downward momentum. It's essential to confirm the downtrend with trend lines and other technical indicators. The key characteristics of the markdown phase are clear lower highs and lower lows, increased trading volume, indicating strong selling interest, breakdowns below support levels, negative market sentiment and news. So we're done with trends and market phases. Now it's time for us to talk about consolidation and breakouts, so you can figure out when to enter in trades. Consolidation occurs when the market trades within a range, showing little price movement. This phase often precedes significant price movements and provides traders with valuable clues about future trends. During consolidation, prices move sideways, forming a range. Traders watch for breakouts, where the price moves decisively out of the range, indicating the potential start of a new trend. Consolidation phases are characterized by low volatility and narrow price ranges. Traders often stay on the sidelines during consolidation, waiting for a breakout. Consolidation can occur after significant price movements as the market takes a breather and prepares for the next move. The key characteristics of consolidation are: prices move within a defined range with no clear trend, low trading volume compared to trending phases, often follows periods of high volatility or significant price movements, can occur at the beginning, middle, or end of trends. If you remember, we talked about breakouts previously. Now we'll understand more about breakouts, its characteristics, and how to avoid fake breakouts. So as you know already, a breakout occurs when the price moves above resistance or below support. Breakouts can signal the start of a new trend, providing trading opportunities. Breakouts are significant because they indicate a shift in supply and demand dynamics. When the price breaks above resistance, it signals increased buying interest, and when the price breaks below support, it signals increased selling interest. Traders often use breakouts to enter trades in the direction of the new trend. Sometimes the price breaks out and comes back in the same range, making the breakout invalid, but how do we know if a breakout is valid and correct? High trading volume often accompanies breakouts, confirming the strength of the move. Breakouts above resistance levels signal potential bullish trends. Breakouts below support levels signal potential bearish trends. Traders use other indicators, such as volume and momentum, to confirm breakouts. As I said, sometimes breakouts can be false signals, where the price moves out of the range but quickly returns. Traders need to use other indicators and confirm the breakout to avoid false signals. False breakouts occur when the price temporarily moves beyond support or resistance levels but fails to maintain the move, quickly returning to the previous range. As you can see in the image above, the price did a breakout from the resistance and quickly returned to the same range, making this a false breakout, and later broke out in the opposite direction. These false signals can result in losses if not properly managed. To avoid false breakouts, traders look for confirmation through increased volume, retesting of the breakout level, and using additional technical indicators. Now I'll tell you a few simple ways to identify a false breakout. First thing is, price quickly returns to the consolidation range. A defining feature of false breakouts is that the price swiftly reverts back into the consolidation range after initially breaking out. This quick reversal indicates that the breakout lacked sufficient momentum and that the previous level of support or resistance is still in effect. Second thing is that false breakouts are often accompanied by low trading volume during the breakout. False breakouts are frequently characterized by low trading volume. Volume is an important indicator of the strength of a price move. Genuine breakouts are typically accompanied by high volume, reflecting strong participation from market players. In contrast, low volume during a breakout suggests weak commitment, making the breakout more likely to fail. False breakouts can result from market manipulation or lack of follow-through buying or selling. False breakouts can occur due to market manipulation or lack of follow-through buying or selling. Large traders might intentionally push prices past key levels to trigger stop-loss orders from other traders, then reverse the price direction. Alternatively, if there is no substantial buying or selling interest to sustain the breakout, it will quickly fizzle out. Traders use stop-loss orders to manage risk and protect against false breakouts. To mitigate the risks associated with false breakouts, traders often use stop-loss orders. By setting stop-loss orders just beyond support or resistance levels, traders can limit potential losses if a breakout fails. This risk management strategy helps protect against significant capital erosion during volatile market conditions. Understanding these key characteristics of false breakouts is essential for traders to make informed decisions and safeguard their investments. Recognizing the signs of a false breakout can help traders avoid being misled and better manage their trading strategies. Now, we'll dive deep into the world of candlesticks, exploring various patterns and their potential outcomes. This comprehensive guide will enhance your trading skills, and trust me, you will really be able to make more informed decisions after you understand the candlesticks and their psychology. So, let's begin with the basics on what we learned earlier to refresh our memory. So these right here are two candlesticks, the green one being the bullish candlestick and the red one being bearish. All right. So each candlestick represents a specific time period, such as 1 minute, 1 hour, or 1 day. Depending on the time frame you are looking at, a candle shows 4 key prices. Candle open, the price at the beginning of the period. This is where the candle opened. Close. The price at the end of the period, let's say on a 5-minute chart, this candle closed at this point. Wick high, the highest price during the period. Wick low, the lowest price during the period. We'll learn more about these in a second. So candlesticks can be bullish or bearish. Bullish candlestick indicates that the closing price is higher than the opening price, typically shown in green. Bearish candlestick indicates that the closing price is lower than the opening price, typically shown in red. Understanding these basics is crucial before we delve into specific patterns. The candlestick are a popular tool in technical analysis, providing visual insights into price movements and market sentiment. Understanding the anatomy of bullish and bearish candlesticks is crucial for traders to interpret market trends and make informed trading decisions. So over here we have a bullish candlestick. A bullish candlestick indicates that the price of the asset has risen over the specified period, be it 5-minute, 15-minute, etc. Here's a breakdown of its components. The main part of the candlestick is called the body, which represents the price range between the open and close prices. Traditionally, a bullish candlestick is represented in green or white, indicating that the closing price is higher than the opening price. The size of the body reflects the magnitude of the price movement during the period. A larger body signifies a more significant price increase. The thin lines extending above and below the body are called wick shows, where a price moved but failed to maintain. The upper wick represents the highest price reached during the period. It shows the highest point where sellers pushed the price up before it closed lower. The lower wick down here represents the lowest price reached during the period. It shows the lowest point where buyers pushed the price down before it closed higher. The close you can see above is the closing price at the end of the period, typically higher than the opening price for a bullish candlestick. The open, or the opening price, is the price at the beginning of the period, usually lower than the closing price for a bullish candlestick. The interpretation of the bullish candlesticks are: a larger bullish candlestick with minimal wicks indicates strong buying pressure throughout the period. A series of bullish candlesticks forming after a downtrend may signal a potential reversal to an uptrend. Increasing trading volume, when accompanied by bullish candlesticks, suggests strong market conviction in the upward movement. Let's take a look at bearish candlesticks now. A bearish candlestick indicates that the price of the asset has fallen over the specified period. Here's how it differs from a bullish candlestick. The body of a bearish candlestick represents the price range between the open and close prices. Traditionally, a bearish candlestick is represented in red or black, indicating that the closing price is lower than the opening price. A larger body signifies a more significant price decrease during the period. Wicks is similar to bullish candlesticks. Bearish candlesticks have upper and lower wicks. Upper wick represents the highest price reached during the period. It shows where buyers attempted to push the price higher before it closed lower. And the lower wick represents the lowest price reached during the period. It indicates where sellers pushed the price down before it closed higher. The closing price is lower than the opening price for a bearish candlestick. And the opening price is higher than the closing price for a bearish candlestick. Now, the interpretation of bearish candlesticks. Just like in bullish candlesticks, a bearish candlestick with minimal wicks suggests strong selling pressure and potential continuation of the downtrend. A series of bearish candlesticks forming after an uptrend may signal a potential reversal to a downtrend. And a confirmation of the downtrend will be increasing trading volume accompanying bearish candlesticks, or a strong bearish candle indicates strong market conviction in the downward movement. Mastering the anatomy of bullish and bearish candlesticks is essential for traders aiming to navigate the complexities of financial markets. By interpreting these candlestick patterns correctly, traders can identify market trends, gauge market sentiment, and time their trades effectively. Continuous practice, combined with understanding market context and other technical indicators, enhances the ability to utilize candlestick patterns for profitable trading strategies. I've given you a brief anatomy of the candlesticks, so now I think I need to take you a step further and introduce you to various types of candle formations, what they say, and what are their possible outcomes. Candlestick patterns are formed by one or more candlesticks and provide insights into market sentiment. Let's explore some of the most popular candlestick formations first, and then one by one learn more about them in detail. The first one, and the most popular one, is Doji. In a Doji, the open and close prices are nearly equal, resulting in a very small body, which indicates market indecision. The outcome of Doji is a potential reversal if followed by a strong bullish or bearish candle. Then we have the hammer and hanging man formation. The hammer formation on the left indicates a possible bullish reversal pattern with a long lower wick found at the bottom of a downtrend. The hanging man on the right side of this picture indicates a bearish reversal pattern with a long lower wick found at the top of an uptrend. Now the engulfing patterns. The bullish engulfing is simply a small bearish candle followed by a larger bullish candle, as shown on the left side. And the bearish engulfing is simply a small bullish candle followed by a larger bearish candle. On the fourth number, we have the morning star and evening star candle formations. The morning star on the left is a bullish 3-candle pattern indicating a potential uptrend reversal. The evening star candle formation on the right is a bearish 3-candle pattern indicating a potential downtrend reversal. And then at last we have the inverted hammer and the shooting star. Inverted hammer is a bullish reversal pattern with a long upper wick found at the bottom of a downtrend, while the shooting star is a bearish reversal pattern with a long upper wick found at the top of an uptrend. Now let's dive deeper into the key patterns we just introduced, starting with a doji. A doji candlestick forms when the opening and closing prices are almost identical. This pattern signifies a state of indecision between buyers and sellers. When a doji appears after a strong trend, it can indicate that the trend is losing strength and a reversal may be imminent. However, confirmation from subsequent candles is essential before acting on the signal. This picture above shows the types of doji candles there is. Hammer and hanging man. The hammer is a bullish reversal pattern that appears at the bottom of a downtrend. Its long lower wick suggests that sellers drove the price down during the session, but strong buying pressure pushed it back up, closing near the open price. This indicates potential bullish momentum. The potential outcome of hammer is, if followed by a bullish candlestick, it suggests that the market may reverse to an uptrend, providing an opportunity for long positions. The hanging man, despite its similar appearance, occurs at the top of an uptrend and signals potential bearish momentum. The long lower wick indicates that selling pressure is increasing, even if buyers manage to push the price back up temporarily. The potential outcome of hanging man is, if it is followed by a bearish candlestick, it suggests that the market may reverse to a downtrend, providing an opportunity for short positions. The engulfing patterns. The engulfing patterns are powerful reversal indicators. A bullish engulfing pattern occurs when a small bearish candlestick is followed by a larger bullish candlestick, engulfing the previous candle. This indicates a shift in market sentiment from bearish to bullish. The potential outcome of bullish engulfing is that the appearance of a bullish engulfing pattern often signals a potential upward reversal, making it a good entry point for long trades. Conversely, a bearish engulfing pattern signals a shift from bullish to bearish sentiment. It occurs when a small bullish candlestick is followed by a larger bearish candlestick. The appearance of a bearish engulfing pattern often signals a potential downward reversal, making it a good entry point for short trades. The morning star and evening star candle formations. The morning star is a bullish reversal pattern that appears at the bottom of a downtrend. It consists of a long bearish candle, a small indecisive candle, and a long bullish candle. This formation suggests that selling pressure is weakening and buying interest is increasing. Potential outcome of morning star is that this pattern often signals the start of a new uptrend, making it a good entry point for long trades. The evening star is the bearish counterpart, appearing at the top of an uptrend and indicating potential downward movement. The potential outcome of evening star is that this pattern often signals the start of a new downtrend, making it a good entry point for short trades. Shooting star and inverted hammer. The shooting star is a bearish reversal pattern that forms after an uptrend. Its long upper wick suggests that buyers drove the price up during the session, but strong selling pressure pushed it back down, indicating potential bearish momentum. Potential outcome of shooting star is that this pattern often signals a reversal to a downtrend, making it a good entry point for short trades. The inverted hammer, on the other hand, is a bullish reversal pattern found at the bottom of a downtrend. Its long upper wick suggests that sellers drove the price down during the session, but strong buying pressure pushed it back up, indicating potential bullish momentum. And its potential outcome is that this pattern often signals a reversal to an uptrend, making it a good entry point for long trades. Now we'll see some practical application and trading strategies which will also help us in our technical analysis. All right, so now that we understand the key candlestick patterns and their potential outcomes, let's discuss how to apply this knowledge in your trading strategies. Identifying patterns in real time. To identify these patterns in your chart, you need to regularly monitor your charts to identify emerging candlestick patterns. Pay attention to patterns forming at key points in the trend, such as the end of a prolonged uptrend or downtrend. And getting a confirmation on your trades is really essential. Use multiple timeframes to confirm the pattern. For instance, if you see a pattern on a daily chart, check the weekly chart for confirmation. Setting entry and exit points. Once a pattern is identified, determine your entry point based on the confirmation of the pattern. For example, enter a long trade after a bullish pattern is confirmed by the next candle. Set your exit points by considering the potential movement indicated by the pattern. This could be a fixed profit target or trailing stop loss to maximize gains. If you find your trades hitting stop losses, you need to manage your risk management. To manage your risk, you need to implement strict risk management rules to protect your capital. This includes setting stop-loss orders to limit potential losses. Avoid risking more than a small percentage of your trading capital on a single trade to ensure you can withstand a series of losing trades. We will learn more about risk management and risk-to-reward ratio later in the videos, where we will cover risk management in more detail. So now I'll tell you some of the most common mistakes and how to avoid them. Understanding candlestick patterns is crucial, but avoiding common mistakes is equally important. Let's discuss some common pitfalls and how to avoid them. Over-reliance on single patterns. Relying solely on a single candlestick pattern without additional confirmation can lead to false signals. Always use multiple indicators and analysis tools to confirm the pattern before making a trading decision. Ignoring market context. Candlestick patterns should be analyzed within the broader market context, including trends and economic conditions. And it's better to avoid making decisions based on patterns that form in isolation without considering the overall market environment. Failing to confirm patterns. Acting on a pattern without confirmation from subsequent candles increases the risk of false signals. So you need to wait for a confirming candle or other indicators to validate the pattern before entering a trade. Inadequate risk management. Neglecting risk management strategies can lead to significant losses. Always set stop-loss orders and manage your position sizes to protect your capital. Allowing emotions to drive trading decisions can result in impulsive actions and poor outcomes. Stick to your trading plan and strategies and maintain discipline even in volatile market conditions. These are some of the issues that you might face as a beginner trader, but don't you worry. Making these mistakes is very much natural. Every trader goes through these problems. We are diving into an essential aspect of technical analysis in trading: reversal and continuation patterns. These chart patterns help us identify potential changes in market trends, allowing us to make more informed trading decisions. Think of chart patterns as formations created by the price movements on a chart and are used in technical analysis to predict future price movements. Like head and shoulders pattern is a reversal pattern that indicates a potential change in trend from bullish to bearish. A double top is another reversal pattern signaling the end of an uptrend and the start of a downtrend, consisting of two distinct peaks at a similar level with a trough in between. And there are many such chart patterns that comes in two categories: continuation patterns and reversal patterns. The continuation patterns includes flags, pennants, and wedges, etc., suggest that the current trend will resume after a brief consolidation period. The reversal patterns like the head and shoulders and double top, etc., indicate that the existing trend is likely to reverse direction. Identifying these patterns helps traders make informed decisions about entering or exiting trades based on anticipated price movements. By the end of this session, you will understand how to recognize these patterns, how to use candlestick confirmations, and where to enter trades, place stop losses, and set targets. Understanding reversal patterns. Reversal patterns signal a change in the prevailing trend. They indicate that the current trend is losing momentum and a new trend is likely to form in the opposite direction. Here are some common reversal patterns. There are many patterns through which you can profit from, and I will show you how to trade them as we go through this course. So the first pattern that we're going to learn to trade one of the most popularly traded pattern known as the head and shoulders pattern. In the Forex market, it is a popular and effective strategy for identifying potential trend reversals. This right here is how the head and shoulder pattern, or in short known as H and S pattern, looks like. This pattern is formed by three peaks: a higher peak, head, between two lower peaks, shoulders. Understanding how to trade this pattern can provide traders with valuable insights and profitable opportunities. The head and shoulders pattern is a reversal pattern that typically forms after an uptrend. It consists of three main components: the left shoulder, which is the first peak that forms the left shoulder, followed by a decline. The head is the second peak higher than the left shoulder, forms the head, followed by another decline. Right shoulder, or the third peak, is lower than the head and roughly equal to the left shoulder, followed by a decline. So if you see these characteristics, then you have a valid H and S pattern. The pattern is confirmed by a neckline, which is a support line drawn connecting the lows of the two troughs formed between the shoulders and the head. When the price breaks below the neckline, it signals a potential trend reversal from bullish to bearish. Steps to trade the head and shoulders pattern. To trade the head and shoulders pattern effectively, follow these steps. First, identify the pattern. The first step is to identify the head and shoulders pattern on the Forex chart. Look for the characteristic three peaks with the middle peak, head, being the highest. Ensure that the pattern forms after a clear uptrend to validate its significance as a reversal signal. Draw the neckline. Once the pattern is identified, draw the neckline by connecting the lows of the troughs between the shoulders and the head. The neckline can be horizontal or sloping, depending on the specific price action. This line acts as a critical support level. Wait for the breakout. The next step is to wait for the price to break below the neckline. This breakout is the confirmation signal that the trend is likely reversing. It's important to wait for a decisive close below the neckline rather than acting on intraday breaks, which can be false signals. Enter the trade. After the price breaks and closes below the neckline, enter a short sell trade. This is the point where the pattern indicates a shift from an uptrend to a downtrend. It's essential to avoid premature entries before the confirmation to reduce the risk of false signals. Set a stop loss. Risk management is crucial in trading the head and shoulders pattern. Place a stop loss above the right shoulder to protect against unexpected price movements. This ensures that losses are limited if the pattern fails and the price resumes its upward movement. Set a profit target. To determine the profit target, measure the vertical distance from the head to the neckline. Project this distance downwards from the point where the price breaks the neckline. This projection gives an estimate of the potential price movement and helps in setting realistic profit targets. Key considerations for trading the head and shoulders pattern. Volume confirmation. Volume plays a significant role in confirming the validity of the head and shoulders pattern. Ideally, the volume should increase during the formation of the left shoulder and the head, and then decrease as the right shoulder forms. A surge in volume during the breakout below the neckline adds further confirmation to the pattern. Market context. Consider the broader market context when trading the head and shoulders pattern. Ensure that other technical indicators and market conditions support the potential reversal. For instance, if the overall market sentiment is bearish, the pattern's reliability as a reversal signal is higher. Time frame. The head and shoulders pattern can form on various time frames, from intraday charts to daily and weekly charts. The reliability of the pattern increases with higher time frames as they represent more significant market movements. However, shorter time frames can offer more frequent trading opportunities. Key considerations for trading the head and shoulders pattern. Volume plays a significant role in confirming the validity of the head and shoulders pattern. Ideally, the volume should increase during the formation of the left shoulder and the head, and then decrease as the right shoulder forms. A surge in volume during the breakout below the neckline adds further confirmation to the pattern. Consider the broader market context when trading the head and shoulders pattern. Ensure that other technical indicators and market conditions support the potential reversal. For instance, if the overall market sentiment is bearish, the pattern's reliability as a reversal signal is higher. Time frame. The head and shoulders pattern can form on various time frames, from intraday charts to daily and weekly charts. The reliability of the pattern increases with higher time frames as they represent more significant market movements. However, shorter time frames can offer more frequent trading opportunities. The very opposite of the head and shoulder pattern is the inverse head and shoulders pattern. The inverse head and shoulders is the opposite of the head and shoulders pattern. It typically forms after a downtrend. Its confirmation is when the price breaks above the neckline. You can enter the trade when the price closes above the neckline. Place the stop loss below the right shoulder, and measure the distance from the head to the neckline and project it upwards from the neckline for the target. Double top and double bottom. A double top occurs after an uptrend and consists of two peaks at roughly the same level. A double bottom occurs after a downtrend and consists of two troughs at roughly the same level. The pattern is confirmed when the price breaks below the neckline for double top or above the neckline for double bottom. Enter the trade when the price closes below the neckline, double top, or above the neckline, double bottom, as shown in the picture above. Place the stop loss halfway above from the second peak for double top or halfway below the second trough, double bottom. Measure the height of the pattern and project it downwards for double top or upwards for double bottom. I'm not going to go in much details for these patterns as they are very simple, and I'm sure you're going to figure them out by yourself, as we have a lot of other topics to cover as, well, I'm going to speed up the explanations of these breakout patterns from here. Alright, so now let's understand the continuation patterns. Continuation patterns indicate that the current trend will likely continue after a brief consolidation period. Here are some common continuation patterns. So here we have flags and pennants. Flags, the one on the left, are small rectangular patterns that slope against the prevailing trend, while pennants are small symmetrical triangles. The pattern is confirmed when the price breaks out of the flag or pennant in the direction of the prevailing trend. Enter the trade when the price closes above the flag or pennant for an uptrend or below for a downtrend. Place the stop loss below the flag or pennant in an uptrend or above in a downtrend. Measure the height of the flagpole, the initial sharp move, and project it in the direction of the breakout. Triangles, ascending, descending, and symmetrical. Asterisk, asterisk, description, asterisk, asterisk. Ascending triangles have a flat upper boundary and rising lower boundary. Descending triangles have a flat lower boundary and falling upper boundary. Symmetrical triangles have converging trend lines. Asterisk, asterisk, video explanation, asterisk, asterisk, insert video link. Asterisk, asterisk, trading steps, asterisk, asterisk. 1. Asterisk, asterisk, confirmation. Asterisk, asterisk. The pattern is confirmed when the price breaks out of the triangle in the direction of the prevailing trend. 2. Asterisk, asterisk, entry. Asterisk, asterisk, enter the trade when the price closes above the upper boundary for an uptrend or below the lower boundary for a downtrend. 3. Asterisk, asterisk, stop loss. Asterisk, asterisk. Place the stop loss below the lower boundary in an uptrend or above the upper boundary in a downtrend. 4. Asterisk, asterisk. Target. Asterisk, asterisk. Measure the height of the triangle at its widest point and project it in the direction of the breakout. Hash, 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 2.3 rectangles. Asterisk, asterisk, description, asterisk, asterisk, rectangles form when the price moves sideways between two parallel horizontal lines. Asterisk, asterisk, video explanation, asterisk, asterisk, insert video link. Asterisk, asterisk, trading steps, asterisk, asterisk. 1. Asterisk, asterisk. Confirmation, asterisk, asterisk. The pattern is confirmed when the price breaks out of the rectangle in the direction of the prevailing trend. 2. Asterisk, asterisk, entry. Asterisk, asterisk. Enter the trade when the price closes above the upper boundary for an uptrend or below the lower boundary for a downtrend. 3. Asterisk, asterisk, stop loss. Asterisk, asterisk. Place the stop loss below the lower boundary in an uptrend or above the upper boundary in a downtrend. 4. Asterisk, asterisk, target. Asterisk, asterisk. Measure the height of the rectangle and project it in the direction of the breakout. Now here we have the triangles pattern. Before we delve into its types, let me tell you, triangle patterns are very unique patterns in technical analysis because they do not inherently indicate a specific direction for future price movements. Instead, triangles represent a period of consolidation where the price is narrowing into a tighter range, reflecting a balance between buyers and sellers. There are 3 types of them: ascending, descending, and symmetrical. Ascending triangles have a flat upper boundary and rising lower boundary. Descending triangles have a flat lower boundary and falling upper boundary. Symmetrical triangles have converging trend lines. The pattern is confirmed when the price breaks out of the triangle in the direction of the prevailing trend. Enter the trade when the price closes above the upper boundary for an uptrend or below the lower boundary for a downtrend. Place the stop loss below the lower boundary in an uptrend or above the upper boundary in a downtrend. Measure the height of the triangle at its widest point and project it in the direction of the breakout. Now let me ask you a question. Have you ever heard about the exponential moving averages, or also known as the EMAs? If you don't know what they are then just sit tight. Because now with this topic begins our journey on learning indicators on the charts and learn to understand and use them to our advantage in making profits from the trades. So, exponential moving averages, or EMAs, are very powerful tools in technical analysis that help traders identify trends and gauge market sentiment. Unlike simple moving averages, which give equal weight to all data points in a given period, EMAs prioritize recent data, making them more responsive to current price changes. This responsiveness makes EMAs particularly valuable in dynamic markets, where rapid price movements can significantly impact trading decisions. To understand how EMAs indicate market sentiment, it's essential to comprehend how they are calculated and used. The EMA is derived by applying a weighting factor to the most recent price, which ensures that the latest data has a more significant influence on the average. This factor depends on the chosen time period for the EMA. For instance, a 12-day EMA will react more quickly to price changes than a 26-day EMA due to its shorter look-back period. In practice, EMAs are plotted on price charts to smooth out price fluctuations and highlight the underlying trend. When the price is above the EMA, it suggests that the market sentiment is bullish, indicating a potential uptrend. Conversely, when the price is below the EMA, it implies a bearish sentiment, signaling a potential downtrend. The crossover of two EMAs, typically a short-term EMA and a long-term EMA, is a common trading signal. For example, when a short-term EMA, example 20, crosses above a long-term EMA, example 50-day, it generates a bullish signal known as a golden cross. This crossover suggests that the market sentiment is shifting towards a bullish trend, and traders might consider entering long positions. On the other hand, when the short-term EMA crosses below the long-term EMA, it produces a bearish signal, known as a death cross, indicating a potential shift towards a downtrend and prompting traders to consider short positions. While EMAs are powerful, relying solely on them can lead to false signals, especially in volatile markets. Therefore, combining EMAs with other technical indicators and confirmations is crucial for making well-informed trading decisions. One effective method is to use EMAs alongside support and resistance levels. These levels are critical price points where the asset has historically reversed its direction. When the price approaches a support level while the EMA indicates a bullish trend, it reinforces the likelihood of a price bounce, providing a stronger buy signal. Similarly, if the price nears a resistance level with a bearish EMA crossover, it strengthens the sell signal. You get the point. Another useful confirmation tool is the Relative Strength Index, RSI. It is a momentum oscillator that measures the speed and change of price movements. The RSI ranges from 0 to 100, with readings above 70 indicating overbought conditions and below 30 suggesting oversold conditions. When an EMA crossover aligns with an RSI reading in the overbought or oversold territory, it enhances the trade signal's reliability. For instance, a bullish EMA crossover coupled with an RSI below 30 provides a strong buy signal, indicating that the asset is oversold and due for a rebound. Conversely, a bearish EMA crossover with an RSI above 70 suggests that the asset is overbought and poised for a decline. Volume analysis is another essential confirmation tool. Volume represents the number of shares or contracts traded in a security, reflecting the market's interest in that security. When a price move is accompanied by high volume, it indicates strong market participation and validates the price movement. For example, a bullish EMA crossover confirmed by increasing volume suggests that the upward move is supported by strong buying interest, making it a more reliable buy signal. Conversely, a bearish EMA crossover with rising volume indicates robust selling pressure, reinforcing the sell signal. To take a trade using EMAs and other confirmations, follow these steps. First, identify the trend by plotting EMAs on the price chart. Use a combination of short-term and long-term EMAs to detect potential crossover signals. Once a crossover is identified, check for additional confirmations such as support and resistance levels, RSI readings, and volume analysis. If the trade signal aligns with these confirmations, it enhances the trade's probability of success. Determine your entry point based on the EMA crossover and confirmation signals. For a bullish trade, enter when the short-term EMA crosses above the long-term EMA, supported by additional confirmations. For a bearish trade, enter when the short-term EMA crosses below the long-term EMA, with supporting confirmations. Establish your stop loss to manage risk. Place it below the most recent swing low for a bullish trade, or above the most recent swing high for a bearish trade. This ensures that your losses are limited if the trade does not go as planned. Set your profit target based on key resistance levels for bullish trades or support levels for bearish trades. Consider using a risk-reward ratio of at least 1:2 to ensure that potential profits outweigh potential losses. Monitor your trade and be prepared to adjust your strategy if the market conditions change. If the EMA crossover reverses or if other indicators show conflicting signals, consider exiting the trade to protect your capital. By following these steps and using EMAs in conjunction with other technical indicators, traders can make more informed decisions and increase their chances of success in the market. Okay, so as you can see in this chart that I've already marked the support and resistance, this right here is our support, and these are our different resistance levels. So, in this tutorial, we're going to learn how to use EMAs as signals for buying and selling opportunities. We'll try finding proper confirmations before entering these trades. I hope whatever we've learned so far is still in your mind and practice. So let's get on with this tutorial. As you can see that here on this chart, we have a section on the top called the indicators. We're going to click that. And here I already have the EMA and my EMA is right here. This indicator has the 20, 50, 100, and 200 EMA. It doesn't matter which EMA you use as long as you apply the same concept to them. You can add this MA indicator by typing EMA over here, and I think that it will be on top of the list, like this here. Let me click on it so I can add it on my chart. You can also start by clicking on the left star. We're going to come back to this screen and wait for our EMAs to appear. Yeah. So let me zoom it a little so that you can see it better. These are the exponential moving averages of 20, 50, 100, and 200 day. So now we have the EMAs on our chart. The red being the 20, the brown as 50, the light blue line as 100, and the blue one acting as 200. But I personally use only two of these EMAs, which is the 20-day EMA and 200-day EMA. So we're going to go to the settings of this indicator and hide these two EMAs in the middle. This one is 20. And this one is 200. I'm going to quickly increase their thickness so that they are better visible. Do the same for the 200-day, and done. So now we only have the 20-day and the 200-day EMAs on our chart. So if we zoom in a little over here, we notice something. Over here, what we see is a golden cross that has occurred when the short-term EMA, 20, has crossed above the larger term EMA, 200. This golden cross right here indicates the potential bullishness of the market, but we're not going to open our buy positions right away. This EMA cross is just our confirmation number 1. So if we zoom out a little bit, we're going to notice something else here as, well, if you were paying attention in the patterns class, you will definitely notice something here on this chart. Let me zoom it a little so you can guess what I'm talking about. Still didn't get it. Look over here, this right here is the pattern I'm talking about, forming an inverse head and shoulders pattern. Right here, we have its first shoulder, the head and the second inverse head, and of course the neckline. Let me get my rectangular tool and mark its neckline. This neckline is also playing the role of resistance area. It is established since the price rejected from here a couple of times. If you still don't see the H&S clearly, then don't worry. Just wait a sec. Let me go and look for my head and shoulder tool. Let me mark its left shoulder, the head, and the right shoulder. Let me make its head more proper, aligning it with the lowest price, just for styling it. So now I hope that now you can see the inverse head and shoulder pattern more clearly. The price has not yet broke above the neckline, resulting a breakout, so we will wait for that to happen. and when the breakout occurs, that will be our confirmation number 2. So what you will do now is when the price breaks above the neckline area, and one of the candle closes above that area, you will enter in a buy position above, but you may wait for the candle to close above the neckline first. When that happens, you take that as your confirmation number 3, and after this third confirmation, you take your entry in this setup with a buy position above the neck of this inverse H&S. Now you may ask where to set up my stop loss and where to set the targets. So for stop loss, we will use our Fibonacci tool after placing the Fibonacci tool from the previous low to the previous high. We will place our stop loss a little below the 0.6 level of Fib, so if the price ever comes down to retracement at this level, our stop loss doesn't get hunted. So let's extend this stop loss to here. And let's get rid of the Fibonacci now. To place our profit targets, we will look at the previous highs. You can also use Fibonacci to find the profit targets. The results will come out very similar. Let's place our first profit target right here on this high. Now let's make the color of this line as green, which I will use to indicate my take profit levels. Let's zoom out a bit and place our take profit 2 on this high right here where the resistance is. Let's extend this from here. And on this side as well, now this would be a very beautiful 1:2 ratio trade. I hope you're still following me. This right here is the EMAs, and here is the golden crosses, which is our first confirmation. And this formation is the inverse head and shoulder, our bullish confirmation number 2. When the price broke out of this area of neckline, that is our confirmation number 3, where we will enter in this trade. This right here is our first take profit level where we will book a little bit of our profits. And this one is our take profit level 2. As I said before, I have already marked all the big and small support and resistance areas in chart, because however basic their concept is, it is still a very powerful one. So let's say that if I wanted to take a little bit of more risk, I can extend my take profit onto this next resistance book, partials on this levels as well. Let's mark that level onto our chart right here on this resistance here. Let me go ahead and extend this right here. As you can see that this is almost 1:3 ratio trade SIY, for example, that in case of stop loss hit you lose $1, and in case of all targets hit you gain $3. What you lose and what you gain is solely based on how much margin you take a trade with. So you need to be careful with your portfolio and follow the risk management rules that I will share with you in this course. Now let's dive deep into understanding the Relative Strength Index, RSI, and how you can effectively use it to make trading decisions. The RSI is a powerful momentum oscillator that measures the speed and change of price movements, which can help you determine overbought and oversold conditions in the market. The RSI ranges from 0 to 100. Traditionally, RSI levels above 70 are considered overbought, indicating that the asset may be overvalued and due for a correction. Conversely, levels below 30 are considered oversold, suggesting that the asset may be undervalued and ripe for a rebound. These levels help traders identify potential reversal points. Imagine you're driving a car. The speedometer indicates how fast you're going. If you're driving too fast, over 70, you might need to slow down to avoid accidents. If you're driving too slow, under 30, you might need to speed up to stay safe on the highway. Similarly, the RSI acts like a speedometer for the market, helping traders gauge the momentum of price movements. How to use RSI for trading. Identifying if the conditions are overbought or oversold. So when the RSI crosses above the 70 level, it signals that the asset might be overbought. This could be a good time to consider selling or taking profits. When the RSI drops below the 30 level, it indicates that the asset might be oversold. This could be a potential buying opportunity. Divergences. There are two types of divergences in RSI bullish and bearish. A bullish divergence occurs when the price makes a new low, but the RSI makes a higher low. This suggests that the selling pressure is weakening and a reversal might be imminent. A bearish divergence happens when the price makes a new high, but the RSI makes a lower high. This indicates that the buying pressure is decreasing and a reversal could be on the horizon. Centerline crossovers. When the RSI crosses above the 50 level, it indicates that the average gains are higher than the average losses, suggesting bullish momentum. When the RSI falls below the 50 level, it suggests bearish momentum as the average losses outweigh the average gains. Using RSI with other indicators. Combining RSI with other technical indicators like moving averages or MACD can provide more robust trading signals. For example, if the RSI indicates overbought conditions and the price is also hitting a resistance level, this dual confirmation can strengthen the decision to sell. Practical trading strategies. There are various ways and strategies you can implement on your trades with this indicator. First one is the RSI overbought oversold strategy. Look for RSI levels above 70 to consider selling positions. You might place a stop loss above recent highs to manage risk. Look for RSI levels below 30 to consider buying positions. A stop loss can be placed below recent lows. And one of the most powerful strategy, of course, the RSI divergence strategy. Identify bullish divergences by looking for higher lows in RSI while the price makes lower lows. This can be a signal to enter long positions. Spot bearish divergences by observing lower highs in RSI while the price makes higher highs. This can be an indication to enter short positions. RSI swing rejection strategy. In this approach, traders look for the RSI to move into overbought or oversold territory, retrace back within normal levels, and then move back again in the same direction. For instance, in an uptrend, wait for the RSI to go above 70, dip below, and then cross back above 70 before entering a buy trade. You can also manage your trades with RSI, like setting targets, placing stop losses, and adjusting your ongoing strategies. Targets can be set based on previous support and resistance levels. In an overbought scenario, you can set a target at the next support level. In an oversold scenario, targets can be placed at the next resistance level. Placing stop losses. Stops can be placed beyond significant price levels. For example, in a bullish trade triggered by an RSI below 30, place a stop loss below the recent low. Adjusting strategies. It's crucial to adjust RSI levels according to market conditions. In highly volatile markets, you might want to use more extreme RSI levels, example 80/20ths, to avoid false signals. By understanding these concepts and integrating them into your trading routine, you'll be well equipped to make informed decisions based on RSI signals. Remember, no indicator is foolproof, and it's essential to consider broader market context and other indicators for confirmation. Keep practicing and refining your approach to develop a strategy that works best for you. These right here are several types of divergences which you need to learn and practice. I want you to quickly take a screenshot of it so we can continue with the tutorial. Alright, so here we are at the chart of Ethereum USDT. So let me remind you that whatever technical analysis that you've learned so far, whatever market phases or the patterns that you've learned can be used in any other markets as well, such as crypto, stocks, etc. So here we are on the chart right here, on the daily time frame. So the first thing we are going to do is click here and we will add the relative strength index indicator. I have it saved right here. You can go ahead and search it up right there. So this is how the RSI indicator looks like. You have the 70 above area, which is the overbought area. And this is the oversold area. These are all the 50, 70, 30 areas, as you can see. We'll just bring it down like this to make the chart bigger again. So both the chart and RSI are visible clearly. Make it fit perfectly here. So we will go to the 4-hour time frame. And the first thing that you may notice here is that we have something going on around here. It is the 20 and 200-day EMA bullish crossover right here. But this, I think, is a very great example of false signals, where you think the market is acting on a bullish sentiment. Let me open the RSI here. As you can see, this is a bearish divergence, as in this top is higher and this one is lower, while the price is making equal highs, completely diverging up there. I think you are noticing it. Let me just mark it like that on the RSI. And the price over here is just equal and straight as an arrow, forming a divergence in the price and RSI. I hope you can see the difference here with the price and the RSI indicator. Let me take my arrow marker from here and mark this RSI here. Messed it there. Give me a second. Let me make that again here. We have a high and a lower high structure, which is kind of like a downtrend. And here, as you can see, it is very straight and making equal highs, unlike the RSI. Now, even though here we saw a bullish EMA, we are seeing a bearish divergence. The sentiment here is mixed, so let's try to see what else we find in the chart. So here we have a structure that is kind of like an uptrend here, price making higher highs and higher lows here. There's also a small fake out here, so what can happen here is that we are at this resistance level. What will happen here is, since we have a very unbiased mixed sentiment here, it would be better to avoid taking any trades here. But we can surely consolidate here near this resistance and come down like this over here, or just fall from here. Right away, the bearish divergence will be our first confirmation, and the rejection from the resistance will be our second confirmation. So now, as you can see, we have already started to fall below this level. We also started to reject from this level of resistance. So how do we take a trade in this? You may ask, let me show that to you. So firstly, what we will do is we will wait this candle to break below this EMA that is acting as support line. This EMA in red, the 20-day EMA right here. And also, this level here is a support. If we break below this level, that is a change in character, which is good for us, meaning that this shift in structure is turning from bullish to bearish. So what we will do is we will draw this rectangle here like this, so when the price falls down below this area, we can expect it to fall furthermore. And if the price does falls like this, we will take our short trade right here. So when the price starts to fall below this level, we will start to make profits. So we will stretch our stop loss and keep it here on this high also where the resistance is. A movement. Something like this is what I expect to happen in the coming days. Here we fall below. Like this, and our buy position will be triggered here. And what we will do for our take profit is we will use my favorite tool, again, the Fibonacci tool. These are the 0.5 and 0.6 levels of the Fibonacci, also known as the golden zone. So what I will do is I will stretch my take profit till here. Looks good. So now what will happen here is that we have liquidity here this long. What you see here is liquidity. I will explain more about it later in detail, but you can just say that all the traders who are in their buy position might place their stop losses around here. So again, what will happen here is that when this breaks, we will come down here a little bit up like this. Then we will fall down here and maybe take a reversal to the upside, as it is a 0.6 level of fib where the chances of reversal to the upside is most likely. So now we have a beautiful trade setup ready. That is 1.73 risk to ratio now. We will wait for it to come to our entry, take our positions, and book profits along the way. The Moving Average Convergence Divergence, MACD, is a trend-following momentum indicator that reveals the relationship between two moving averages of a security's price. It's widely used in technical analysis to identify potential buy and sell signals. The MACD is composed of three main elements: the MACD line, the signal line, and the histogram. The MACD line represents the difference between two exponentially smoothed moving averages of closing prices. The signal line is an exponentially smooth moving average of the MACD line, and the histogram shows the difference between the MACD line and the signal line. By understanding these components, traders can make more informed decisions based on the behavior of these lines and the histogram. Visualizing the MACD components helps in grasping their roles. Imagine a graph with a blue MACD line fluctuating above and below a center line. This line indicates the convergence or divergence of the moving averages. Adding a red signal line, which smooths out the MACD line's movements, makes it easier to spot potential buy or sell signals when the lines cross. The histogram, represented by vertical bars, measures the distance between the MACD line and the signal line. Green bars indicate upward momentum, while red bars signify downward momentum. These visual aids are crucial for interpreting the MACD. The MACD is primarily interpreted through crossovers, divergence, and dramatic rise. Crossovers occur when the MACD line crosses above or below the signal line, signaling potential buy or sell points. A bullish crossover happens when the MACD line moves above the signal line, indicating it may be a good time to buy. Conversely, a bearish crossover occurs when the MACD line drops below the signal line, suggesting a sell opportunity. Divergence between the price and the MACD can signal an impending reversal. For example, if the price makes new highs while the MACD fails to do so, it indicates a potential trend change. A dramatic rise in the MACD, where the shorter moving average pulls significantly away from the longer-term moving average, can signal that the security is overbought and may soon return to normal levels. Understanding these concepts is fundamental for utilizing the MACD effectively in trading. Taking trades based on MACD. First, you need to be identifying the trend. Taking trades based on the MACD involves a systematic approach. First, it's essential to identify the overall trend of the market, as the MACD works best in trending markets. This can be done by examining longer-term charts to determine if the market is in an uptrend or downtrend. Look for crossovers. Once the trend is established, traders look for crossovers between the MACD line and the signal line. In an uptrend, focus on bullish crossovers where the MACD line crosses above the signal line. In a downtrend, look for bearish crossovers where the MACD line crosses below the signal line. Confirming with the histogram. Confirming these signals with the histogram is crucial. A positive histogram supports a bullish crossover, while a negative histogram supports a bearish crossover. This confirmation step adds another layer of reliability to the signals generated by the MACD. Setting entry and exit points. Setting entry and exit points is the next step in the trading strategy. Enter the trade after a confirmed crossover and histogram confirmation. For a buy signal, this would be after the MACD line crosses above the signal line and the histogram is positive. The exit point should be when the opposite signal occurs. For example, if you entered on a bullish crossover, exit when a bearish crossover happens, indicating the MACD line has crossed below the signal line. Example trade scenarios. Bullish scenario. To illustrate this strategy, consider a bullish scenario. First, identify the uptrend by examining a daily price chart that shows higher highs and higher lows. Next, look for a bullish crossover on the MACD chart where the MACD line crosses above the signal line and the histogram is positive. Enter the trade at the bullish crossover confirmation, placing the entry point at the crossover. Set the stop loss just below the recent swing low to manage risk. Exit the trade when the next bearish crossover occurs, indicating that the MACD line has crossed below the signal line. This methodical approach ensures that each step of the trade is planned and executed based on the MACD signals. Now the bearish scenario. In a bearish scenario, the steps are similar but in reverse. First, identify the downtrend by examining a daily price chart showing lower highs and lower lows. Look for a bearish crossover on the MACD chart, where the MACD line crosses below the signal line and the histogram is negative. Enter the trade at the bearish crossover confirmation, placing the entry point at the crossover. Set the stop loss just above the recent swing high to manage risk. Exit the trade when the next bullish crossover occurs, indicating that the MACD line has crossed above the signal line. This approach ensures that trades are taken based on solid MACD signals and are protected by proper risk management techniques. In conclusion, the MACD is a powerful tool for identifying potential buy and sell signals in the market. By understanding and utilizing MACD crossovers, divergences, and the histogram, traders can make informed decisions and enhance their trading strategies. It is essential to confirm MACD signals with other technical indicators and implement proper risk management to safeguard trades. This detailed explanation, along with visual aids, should provide a comprehensive understanding of how to use the MACD effectively in trading, making it an invaluable part of a trader's toolkit. Okay, so here we are on the chart of gold USD. I will try to give you tutorials on indicators and also show you how you can find trades and setups on the chart with technical analysis. I'm not going to go into their in-depth explanation as there are many different ways and features through which you can use them for your trades. So that is, my friend, something that you will have to discover and explore by yourself. And trust me, it is better this way. So let's go ahead and add the MACD indicator from the Indicators tab. Here, the Moving Average Convergence Divergence Indicator. So the MACD is one of the most popular and useful indicators apart from EMA's and RSI indicator. This is how the MACD indicator looks like. This is the histogram. This is the signal line. The more further away it gets from the center line, the more stronger the trend is. And when it's a crossover farther away from the center line, you can expect the signal to be as stronger as you can see here. We got the signal of sell and the market moved downwards. Let me show that to you. Here on this point, we received the signal of sell and we are seeing a downtrend after that. Let me mark that up for you. Here, as you can see, this is the bearish crossover right here. And this right here is the beginning of this downtrend. And as you can see that we went decently low after the bearish MACD cross. This right here is daily time frame, so let's zoom out and see what else we can find on this chart and see what information we can gather here that will help us understand the sentiment of the market. So, the first thing that we notice on the daily time frame is that here we are seeing this candle. This candle indicates that there is a potential reversal to the downside, so it may come down near this point for sure. So if it breaks below this area, then we might be looking to short this on the daily time frame. If the price breaks below this area, then these candles here outside our resistance will become a fake out. But for that to act as a fake out, we need the price to break below first. So okay, we got our confirmation number 1, the candle above. So now let's go on to 4-hour time frame to look for more confirmations. Now, before we switch time frames, I need you to see that this sideways market acting right now, and this candle above could act as false signal or a false breakout and eventually come back down here. Eventually, if you don't know how to identify false signals or false breakouts, you can go back to the part where I taught you about breakouts that will help you identify false breakouts and their characteristics. Now let's switch to 4-hour time frame. Okay, so here we are on the 4-hour time frame. Okay, so right here, I think we have an uptrend here. Right about here. Let me go ahead and mark that uptrend with our trend line. Let's go ahead and match all the higher highs. Do the same for the downside match, all the higher lows. Let me go ahead and make it proper, aligning it with all the higher lows. Okay, now that looks perfect. Now we know for sure that the price will come down here at this trend support. But still, we cannot take a short trade as the market is in an uptrend. So what we will do is we will wait for the distribution phase to occur and we will take our short trade there. So after the uptrend reversal, the market comes down and brings us in profits. When this makes a breakout here, we will open a short trade. Let's say here. Our entry will be here, but wait, why not take an entry in the current market price? Definitely not. This is not how you trade. You trade with confirmation scenarios and possibilities. Do keep that in mind. Entry below this level is good. For the targets, let's use Fib again. Like this. There we go, keeping our target just about at 0.6 level. Okay, so I think that we need to bring up our entry price a little more to get better profits, and good risk to ratio. We will place our stop loss little above the resistance or maybe above the previous high for safety. This looks good, all right. So that about it for this tutorial. Now we will get a brief introduction to volume analysis, and in this lecture you will learn many things about volume that you might have never known, and will help you in getting so much information while you are trading in, be it uptrends or patterns. So get yourself a coffee and sit down, relax to hear more about this. Volume analysis is a crucial aspect of technical analysis that helps traders understand the strength or weakness of a price movement. By examining trading volume, we can gain insights into market trends, potential reversals, and the overall market sentiment. In this session, we will delve deep into the concept of volume analysis and how to effectively use it to make informed trading decisions. We will cover various aspects of volume analysis, including its importance, different patterns, and practical trading strategies. To understand volume and its importance, you need to understand that volume represents the number of shares or contracts traded in a security or market during a given period. It is a direct reflection of the level of interest and activity in that security. High volume typically indicates strong interest and participation from traders, while low volume suggests a lack of interest or indecision. High volume signifies strong interest and can confirm the direction of a trend, whereas low volume indicates weak interest and may suggest a potential reversal or consolidation. To fully grasp the concept of volume, imagine you're at an auction. The number of people bidding on an item, volume, gives you a sense of how desirable that item is. Similarly, in the stock market, high trading volume indicates a high level of interest and activity in a particular security, while low volume might indicate that traders are losing interest or waiting for more information before making a move. Analyzing volume spikes. Volume spikes occur when there is a sudden increase in trading volume. These spikes often accompany significant price movements and can provide valuable clues about future price direction. For instance, in a chart showing a sharp increase in volume during a price surge, this spike confirms the strength of the upward movement, suggesting that the trend is likely to continue. Conversely, a spike in volume during a price drop can indicate strong selling pressure, reinforcing the downward trend. Consider an example where a company's stock suddenly surges on news of a new product launch. The accompanying volume spike suggests that many traders are buying into the stock, indicating a strong belief in the company's future prospects. This increased volume validates the price movement, making it more likely that the upward trend will continue. One of the most effective ways to use volume analysis is to confirm price trends. In an uptrend, high volume confirms the trend's strength, indicating active buyer participation, pushing prices higher. Conversely, in a downtrend, high volume confirms the trend's strength, showing that sellers are dominant, driving prices lower. However, during a price increase or decrease with low volume, it may indicate a lack of conviction, potentially signaling a reversal or consolidation. In practical terms, if you notice a stock rising in price with increasing volume, it suggests that the upward trend is strong and likely to continue. On the other hand, if the price is rising but the volume is decreasing, it could indicate that the trend is losing momentum and a reversal may be imminent. Similarly, a downtrend accompanied by increasing volume confirms the strength of the sellers, whereas a downtrend with decreasing volume might suggest that the selling pressure is waning and a reversal could be near. Now, certain volume patterns can provide early signals of potential market moves. A volume climax occurs when volume reaches extreme levels, often signaling the end of a trend. For example, a volume climax in an uptrend may indicate a forthcoming reversal, while in a downtrend, it might suggest an exhaustion of selling pressure. Volume divergence happens when price and volume move in opposite directions. If prices are rising but volume is decreasing, it may indicate a weakening trend. Conversely, if prices are falling but volume is increasing, it might suggest an impending reversal. A volume climax can be visualized by looking at a chart where the volume bars suddenly spike to much higher levels than usual. This often occurs at the end of a prolonged trend, where all the remaining buyers or sellers have finally acted, and the market is set for a reversal. For instance, during a prolonged uptrend, if you see a massive volume spike but the price fails to rise significantly, it may indicate that the buyers have exhausted their resources, and a reversal is likely. Volume divergence can be identified by comparing the price and volume movements on a chart. For example, if the price is making higher highs but the volume is decreasing, it suggests that fewer traders are supporting the higher prices, which could lead to a trend reversal. Conversely, if the price is making lower lows but the volume is increasing, it indicates that more traders are participating in the selling, which might foreshadow a continuation of the downtrend. So how do we use volume in our practical trading strategies? In breakout trading, a high volume breakout is a strong buy signal when a security breaks through a key resistance level with high volume. The high volume confirms significant interest and momentum behind the move. Conversely, breakouts that occur with low volume should be approached cautiously, as they may be false breakouts, lacking the necessary participation to sustain the move. Consider a scenario where a stock has been trading within a defined range, and it finally breaks above the resistance level with a significant increase in volume. This high volume breakout suggests that many traders are confident in the new price level, making it a strong buy signal. On the other hand, if the breakout occurs on low volume, it might be a false breakout, as there isn't enough participation to support the new price level. For volume-based entry and exit strategies, enter a trade when a price move is confirmed by high volume, such as buying during an uptrend supported by increasing volume. Similarly, consider exiting a trade when volume diminishes during a price movement. For instance, if you're long in an uptrend and notice decreasing volume, it might be time to take profits. Let's take an example of a trader looking to buy a stock that has been trending upward. If the trader notices that each price increase is accompanied by higher volume, it confirms the strength of the trend, making it a good entry point. Conversely, if the trader is already holding a stock and notices that the volume is decreasing during price increases, it might signal that the trend is losing momentum, and it could be a good time to sell and take profits. In addition to basic volume analysis, there are several advanced techniques that traders can use to gain deeper insights into market dynamics. One such technique is the volume-weighted average price, VWAP, which provides the average price a security has traded at throughout the day, based on both volume and price. Traders often use VWAP to assess whether the current price is over or undervalued relative to the day's trading activity. Another advanced technique is the use of on-balance volume, OBV, which is a momentum indicator that uses volume flow to predict changes in stock price. OBV adds volume on up days and subtracts volume on down days, creating a cumulative total that helps traders identify trends and potential reversals. Volume analysis can be particularly useful in different market conditions, such as during periods of high volatility or in trending markets. During high volatility, volume spikes can help confirm the strength of price movements, providing traders with more confidence in their trades. In trending markets, volume analysis can help identify the sustainability of the trend and potential reversal points. For example, during a period of high volatility, a sudden increase in volume can indicate a strong move, either up or down, and can help traders confirm the direction of the trend. In a trending market, consistent volume increases during price movements suggest a strong trend, while decreasing volume may indicate a weakening trend and potential reversal. To better understand the application of volume analysis, let's look at some practical examples and case studies. Consider a stock that has been trading in a range for several months. One day, the stock breaks out above the resistance level with a significant increase in volume. This high-volume breakout signals a strong buy as it indicates that many traders are confident in the new price level. In this case, a trader who enters the trade based on the volume confirmation is likely to see positive results. Another example is a stock in a downtrend where the price has been decreasing steadily with increasing volume. This increasing volume confirms the strength of the sellers, suggesting that the downtrend is likely to continue. However, if the trader notices that the volume starts to decrease while the price is still falling, it might signal that the selling pressure is waning and a reversal could be near. In this scenario, the trader might consider taking profits or even looking for a buying opportunity if other indicators confirm the potential reversal. So in conclusion, volume analysis is an essential tool for traders, offering insights into market activity and helping to confirm price trends. By understanding and applying volume patterns and signals, traders can enhance their decision-making process and improve their trading performance. Remember, volume should always be considered in conjunction with other technical indicators to provide a comprehensive view of the market. In our next session, we will explore specific trading strategies using volume analysis in more detail, including practical examples and case studies. Introduction to BOS and CHOCH. This lesson is designed to provide you with an in-depth understanding of these concepts, how they can be used to interpret price action, and how to trade them effectively. By the end of this session, you will be well equipped with the knowledge to identify BOS and CHOCH, understand their implications, and apply various trading strategies based on these insights. What is break of structure, BOS? Break of structure, commonly referred to as BOS, is a crucial concept in technical analysis. It signifies a significant change in the price structure, indicating a potential shift in market sentiment and trend direction. Definition and identification. A BOS occurs when the price decisively breaks through a key support or resistance level. For example, in an uptrend, a BOS is confirmed when the price breaks above a previous high, suggesting that the bullish momentum is strong enough to overcome resistance. Conversely, in a downtrend, a BOS is confirmed when the price breaks below a previous low, indicating that the bearish momentum is prevailing. Implications of BOS. Understanding BOS helps traders anticipate the continuation of a trend. When a BOS is identified, it often signals that the current trend will persist, providing traders with the opportunity to enter trades in the direction of the trend. What is change of character, CHOCH? Change of character, or CHOCH, is another vital concept in technical analysis. It indicates a potential reversal in the market by highlighting a shift from one market phase to another, such as from trending to ranging or vice versa. Definition and identification. A CHOCH occurs when there is a break in the established market structure followed by a change in price behavior. For instance, in an uptrend, a CHOCH is identified when the price breaks below a higher low, suggesting a potential shift to a downtrend. In a downtrend, a CHOCH is indicated when the price breaks above a lower high, hinting at a possible move to an uptrend. Implications of CHOCH. Recognizing a CHOCH is crucial for identifying potential reversals. It helps traders position themselves for a change in market direction, which can be highly profitable if timed correctly. Using BOS and CHOCH to understand price action. Price action trading involves analyzing the movement of prices over time to make trading decisions. BOS and CHOCH are fundamental to this approach as they provide insights into the underlying market dynamics. Analyzing trends with BOS. BOS is particularly useful for confirming trend continuations. When the price breaks above a previous high in an uptrend, it confirms that buyers are in control, suggesting that the trend will likely continue. And BOS in a downtrend suggests the continuation similarly. Traders can use this BOS uptrend information to enter long positions with greater confidence. Identifying reversals with CHOCH. CHOCH, on the other hand, is essential for spotting potential reversals. When the price breaks below a higher low in an uptrend, it indicates that the buyers are losing control and a downtrend might be starting. And vice versa. This allows traders to prepare for and capitalize on reversals. Trading strategies using BOS and CHOCH. Let's delve into some specific trading strategies that utilize BOS and CHOCH. Trend following strategy. This strategy involves trading in the direction of the current trend, confirmed by a BOS. The idea is to capitalize on the continuation of a trend after it has been validated by a break of structure. Use the following steps for execution. Identify the prevailing trend using moving averages or other trend indicators. Wait for a BOS to confirm the trend direction. Enter a trade in the direction of the trend, long for uptrend, short for downtrend. Place a stop loss below the recent swing low for long trades or above the recent swing high for short trades. Set a profit target based on the expected continuation of the trend or use a trailing stop to lock in profits. Reversal strategy concept. This strategy aims to identify and trade potential market reversals using CHOCH. It is particularly useful in markets that exhibit frequent changes in direction. Use the following steps for the execution of this strategy. Identify a trending market and monitor for signs of weakening trend momentum. Look for a CHOCH to signal a potential reversal. For example, price breaks below a higher low in an uptrend. Enter a trade in the new direction, short for a downtrend, long for an uptrend. Place a tight stop loss to manage risk just beyond the recent high for short trades or low for long trades. Set a profit target based on the expected move or use a trailing stop. Breakout strategy concept. This strategy focuses on trading breakouts from consolidation phases using BOS to confirm the breakout. The following steps should be taken to execution in this strategy. Identify a consolidation range with clear support and resistance levels. Wait for a BOS to indicate a breakout from the range. Enter a trade in the direction of the breakout, long if breaking resistance, short if breaking support. Place a stop loss just outside the consolidation range to manage risk. Set a profit target based on the size of the consolidation range or use a trailing stop. Conclusion and key takeaways. BOS and CHOCH are invaluable tools for traders looking to understand and capitalize on market movements. By mastering these concepts, you can enhance your ability to interpret price action, identify trading opportunities, and develop effective trading strategies. Whether you are following trends, trading reversals, or looking for breakouts, incorporating BOS and CHOCH into your trading approach can significantly improve your trading performance. This concludes our in-depth guide on BOS and CHOCH. Practice identifying these patterns on historical charts and apply the strategies discussed to gain confidence in using these powerful concepts in your trading. Happy trading! So now we explored break of structure, BOS, and change of character, CHOCH, critical concepts that help us identify potential shifts and continuations in market trends. After a BOS, the market often gravitates towards specific price levels known as liquidity areas. These areas are where significant trading activity occurs, as market participants seek to execute large orders efficiently. Understanding liquidity is essential to grasp how these price levels influence market movements and trader behavior. Let's delve deeper into the concept of liquidity and its importance in trading. Introduction to liquidity. Liquidity is a fundamental concept in trading and investing, referring to how easily an asset can be bought or sold in the market without affecting its price. High liquidity means there are many buyers and sellers, making it easy to trade an asset quickly and at a stable price. Conversely, low liquidity indicates fewer market participants, leading to potential price volatility when buying or selling. In this guide, we'll delve deep into liquidity, its importance, and how it impacts trading decisions, using simple explanations and illustrative images. Understanding liquidity. Definition and basic concept. Liquidity refers to the ease with which an asset can be converted into cash without significantly affecting its price. Assets with high liquidity can be traded quickly and with minimal price changes. For example, major currency pairs like E or USD in the Forex market are highly liquid because they have a large number of buyers and sellers at any given time. High versus low liquidity. High liquidity implies that an asset can be sold or bought quickly at a price close to its current market value. This is because there are many participants willing to trade at any moment. In contrast, low liquidity means fewer participants, which can lead to larger price swings and difficulties in executing trades at desired prices. The importance of liquidity in trading. Efficient trading. High liquidity allows traders to execute large orders without causing significant price changes. This efficiency is crucial for traders who need to enter or exit positions quickly, especially in volatile markets. Price stability. Liquidity contributes to price stability. In a highly liquid market, the presence of many buyers and sellers prevents drastic price fluctuations, leading to more stable and predictable market conditions. Reduced transaction costs. High liquidity often results in lower transaction costs, including narrower bid-ask spreads. The bid-ask spread is the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. In liquid markets, this spread is usually smaller, reducing the cost of trading. Factors affecting liquidity. Market participants. The number and diversity of market participants significantly impact liquidity. More participants, such as institutional investors, retail traders, and market makers, enhance market liquidity by providing a continuous flow of buy and sell orders. Trading volume. High trading volume is a key indicator of liquidity. Assets that are traded frequently and in large quantities tend to have higher liquidity, making it easier to buy or sell them quickly. Market hours. Liquidity can vary depending on market hours. For example, Forex markets are most liquid during overlapping trading sessions of major financial centers like London and New York. Outside these hours, liquidity may decrease, leading to wider spreads and more volatile price movements. Liquidity in different markets. Forex market. The Forex market is known for its high liquidity, especially in major currency pairs like EUR/USD, USD/JPY, and GBP/USD. These pairs are traded around the clock by a diverse range of participants, including banks, corporations, and individual traders. Stock market. In the stock market, blue-chip stocks like Apple or Microsoft are highly liquid due to their popularity and large market capitalization. These stocks have many buyers and sellers, ensuring that trades can be executed quickly and efficiently. Cryptocurrency market. Liquidity in the cryptocurrency market can vary widely. Major cryptocurrencies like Bitcoin and Ethereum typically have high liquidity due to their widespread adoption and large market caps. However, lesser-known altcoins might experience low liquidity, leading to higher volatility and trading risks. Measuring liquidity. Bid-ask spread. One of the simplest ways to measure liquidity is by examining the bid-ask spread. A narrow spread indicates high liquidity as the asset can be traded at prices close to its market value. A wide spread suggests lower liquidity with larger price differences between buyers and sellers. Volume indicators. Volume indicators, such as the volume oscillator or on-balance volume (OBV), help traders assess liquidity by tracking the number of shares or contracts traded over a specific period. High trading volumes generally indicate high liquidity. Market depth. Market depth, displayed in a Level 2 market data window, shows the number of buy and sell orders at different price levels. A deep market with many orders close to the current price indicates high liquidity, while a shallow market with few orders suggests lower liquidity. Liquidity pools and their impact in Forex. In the Forex market, liquidity pools form around key levels, such as previous highs and lows, round numbers, and major support and resistance levels. These pools represent areas with a high concentration of buy and sell orders. Understanding these liquidity pools helps Forex traders predict where significant price movements might occur as the market reacts to these areas. Order flow and market depth in Forex. Order flow in Forex refers to the actual buy and sell orders being executed in the market. Tools like the Level 2 market data window, commonly used in stock trading, are less prevalent in Forex. However, traders can still analyze order flow by observing price action, volume, and the behavior of large market participants. Market depth information in Forex, when available, provides insights into the number of buy and sell orders at various price levels, helping traders assess liquidity. Impact of news and events on Forex liquidity. Major news events, such as central bank announcements, economic data releases, and geopolitical developments, can have a significant impact on Forex liquidity. During these times, liquidity can either surge or dry up rapidly. For example, a central bank's interest rate decision might attract a large number of traders, increasing liquidity. Conversely, unexpected geopolitical events might cause traders to exit positions, reducing liquidity. Understanding how news impacts liquidity helps Forex traders anticipate market reactions and plan their trades accordingly. Advanced concepts in Forex liquidity. Liquidity and Forex market microstructure. The Forex market's microstructure involves the interactions between different participants, such as banks, hedge funds, and retail traders, which determine prices and liquidity. Understanding the microstructure helps traders grasp how liquidity patterns influence price formation in the Forex market. Factors such as the role of market makers and electronic communication networks, ECNs, are crucial in shaping Forex liquidity. Algorithmic trading and Forex liquidity. Algorithmic trading in Forex involves using computer algorithms to execute trades based on predefined criteria. These algorithms can analyze liquidity conditions and optimize trade execution by minimizing market impact and slippage. High-frequency trading, HFT, in Forex relies heavily on liquidity, making rapid trades to profit from small price discrepancies. The role of central banks and liquidity providers in Forex. Central banks and major financial institutions play a significant role as liquidity providers in the Forex market. Their actions, such as setting interest rates and intervening in the currency markets, can significantly impact Forex liquidity. Understanding the role of these institutions helps traders anticipate liquidity shifts and market reactions. Conclusion and key takeaways. Liquidity is a critical factor in trading, influencing trade execution, price stability, and transaction costs. High liquidity markets, such as major currency pairs in Forex trading, provide traders with efficiency and lower risks, while trading in less liquid markets requires careful strategy and risk management. Understanding liquidity and its impact on different markets can significantly enhance trading decisions and outcomes. This comprehensive guide has aimed to provide a deep understanding of liquidity, its importance, and practical applications in trading. By mastering the concept of liquidity, traders can navigate various market conditions more effectively, ensuring better trade execution and improved overall trading performance. Whether you are dealing with high liquidity in major Forex pairs or managing the complexities of low liquidity markets, the principles remain the same. Recognizing the flow of liquidity helps in making more informed and strategic trading decisions. In the realm of Forex trading, understanding liquidity helps traders make smarter moves by predicting where and when price changes are likely to occur. High liquidity means that trades can be executed quickly and at more stable prices, reducing slippage and transaction costs. On the other hand, in markets with lower liquidity, traders need to employ more cautious strategies to mitigate the risks associated with larger price swings and potential difficulties in executing trades. Mastering the concept of liquidity provides a solid foundation for any trading strategy. It allows traders to better understand market behavior, anticipate potential price movements, and execute trades more efficiently. This knowledge not only improves individual trade outcomes, but also enhances overall trading performance by fostering a more strategic and informed approach to the market. Ultimately, the key to successful trading lies in continuous learning and adaptation. The market is ever evolving, and staying informed about concepts like liquidity ensures that traders can maintain a competitive edge. By refining their strategies, improving risk management, and integrating new insights, traders can achieve more consistent and profitable results. Happy trading, and may your understanding of liquidity lead to more insightful and successful trading experiences. Now that we have thoroughly explored the concept of liquidity and how it influences the Forex market, it's time to move on to our next intriguing topic, fair value gaps, FVGs. Just as understanding liquidity helps us grasp the flow of the market, analyzing fair value gaps can provide us with valuable insights into price movements and trading opportunities. So, let's dive into the world of fair value gaps and see how they can enhance our trading strategies. Fair value gaps, those intriguing voids on the price chart, are a fascinating aspect of Forex trading. In Forex, a fair value gap occurs when there's a significant difference between the closing price of one candlestick and the opening price of the next, leaving a noticeable gap on the chart. These gaps can be caused by sudden market news, economic data releases, or major geopolitical events. It's like waking up to find that someone has removed a key chapter from your favorite book. You know something important happened, but you missed the details. The significance of fair value gaps. Fair value gaps are essentially price vacuums where no trading has occurred, and they can tell us a lot about market sentiment and potential future movements. When a gap appears, it often signifies that the market has overreacted or underreacted to a particular event, leaving a vacuum that prices will eventually aim to fill. This concept is rooted in the idea that markets tend to revert to their fair value, much like how water always finds its level. Identifying fair value gaps on the chart. These gaps can be found on various time frames, from minute charts to daily charts, and can serve as reliable indicators for potential market reversals or continuations. For example, if a fair value gap appears during a strong uptrend, it might suggest that the bullish momentum is overextended and a correction is due. Conversely, a gap in a downtrend could indicate overselling, with a bounce likely as the market seeks to restore balance. Trading fair value gaps. Trading these gaps involves a bit of patience and a keen eye for detail. When you spot a fair value gap, you can anticipate that the price will eventually move back to fill it, providing an opportunity to enter a trade. For instance, if a gap occurs in an uptrend, you might look for a pullback to the gap area before considering a long position. Conversely, in a downtrend, a gap might offer a chance to short the market once the price revisits the gap zone. Combining fair value gaps with technical indicators. To effectively trade fair value gaps, it's crucial to combine this observation with other technical indicators and analysis methods. For instance, using moving averages, RSI, Relative Strength Index, or MACD, Moving Average Convergence Divergence, in conjunction with gap analysis can enhance the reliability of your trades. Think of it as a comprehensive toolkit where each tool complements the other to achieve the best result. The role of market context and fundamentals. In addition to technical indicators, understanding the broader market context and fundamentals is essential. Economic calendars, news feeds, and sentiment analysis can provide insights into why a gap occurred and whether it's likely to be filled quickly or remain open for some time. For example, a gap caused by unexpected interest rate changes might behave differently from one caused by routine economic data releases. Fair value gaps also highlight the importance of liquidity in the Forex market. When a gap forms, it often reflects a temporary imbalance between supply and demand. As market participants react to the new information, liquidity tends to return to the gap area, allowing prices to fill the gap. This filling process can create excellent trading opportunities, but it also requires a good understanding of market dynamics to avoid getting caught in false moves. Different types of fair value gaps. However, not all gaps are created equal. Some gaps close quickly, while others can remain open for extended periods. It's crucial to differentiate between types of gaps. Breakaway gaps indicate the start of a new trend, runaway gaps occur within a trend and suggest strong momentum, while exhaustion gaps appear at the end of a trend and signal potential reversals. And a fair value gap is especially popular among price action traders and occurs when there are inefficiencies or imbalances in the market, or when the buying and selling are not equal. Incorporating fair value gap analysis into your strategy. Incorporating fair value gap analysis into your trading strategy can add an insightful dimension to your Forex adventures. It's like being a detective, piecing together clues from the market to make informed decisions. Just remember, while gaps can be lucrative, they also require a solid understanding of market dynamics and risk management. Jumping into a trade solely based on a gap can be as risky as making decisions without complete information. It might pay off, but the odds aren't in your favor. Conclusion. So next time you spot a gap on your Forex chart, take a moment to analyze it, understand the context, and consider how it fits into your overall trading strategy. It could be the missing piece of the puzzle that leads to a successful trade, or at the very least, it'll keep you engaged as you watch the market unfold. Remember, patience and a thorough analysis are key. Fair value gaps can be powerful indicators, but they're not a magic bullet. Combine them with a comprehensive trading plan, and you'll be well on your way to mastering the art of Forex trading. Understanding advanced trading concepts, ICT, smart money, and other trading styles. Forex trading, much like any other financial market, is an ever-evolving arena where various strategies and concepts are employed by traders to gain an edge. Beyond the common trading styles such as scalping, day trading, and swing trading, there are more advanced concepts that seasoned traders use to understand market movements and make informed trading decisions. Among these are ICT, Inner Circle Trader, smart money concepts, and several other trading styles that offer unique perspectives and approaches to trading. This comprehensive guide will delve into these advanced trading concepts, exploring their intricacies and how they can be effectively utilized in the Forex market. Advanced trading concepts are built on a deeper understanding of market mechanics, liquidity, and the behaviors of large institutional players. These concepts often go beyond basic technical and fundamental analysis, incorporating elements such as market psychology, order flow, and the influence of major financial institutions. By mastering these advanced strategies, traders can develop a more nuanced view of the market, allowing for more precise and effective trading decisions. The ICT Inner Circle Trader Methods. ICT, or Inner Circle Trader, is a trading methodology developed by Michael J. Huddleston, who is renowned in the trading community for his unique approach to market analysis. The ICT methods focus on understanding the mechanics of price action, liquidity, and the behaviors of institutional traders. ICT techniques are designed to help traders identify high-probability setups and improve their overall trading performance. One of the core principles of ICT is the concept of market manipulation by large institutions. According to ICT, these institutions, often referred to as smart money, have the ability to move the market to specific price levels to fill their large orders. By understanding these manipulative tactics, traders can align their trades with the movements of smart money, increasing their chances of success. ICT methods emphasize the importance of liquidity pools, which are areas on the chart where there are clusters of stop orders. These pools often attract the attention of institutional traders, who will push the price towards these levels to trigger the stop orders and create liquidity for their large positions. Traders using ICT techniques learn to identify these liquidity pools and use them as potential entry or exit points. Another key aspect of ICT is the use of time-based analysis. ICT traders pay close attention to specific times of the trading day when institutional activity is likely to be higher, such as the London and New York trading sessions. By focusing on these periods, traders can better anticipate significant price movements and adjust their strategies accordingly. Smart money concepts. Smart money concepts are closely related to ICT methods and revolve around understanding the actions of large institutional traders, such as banks, hedge funds, and other financial entities that have the power to influence the market significantly. The primary goal of smart money concepts is to identify the footprints of these large players and align one's trading strategies with their movements. One of the fundamental ideas in smart money concepts is the accumulation and distribution phases of the market. During the accumulation phase, smart money accumulates large positions without significantly moving the market. This phase is often characterized by low volatility and range-bound price action. In the distribution phase, smart money begins to offload their positions, leading to increased volatility and directional price movements. By recognizing these phases, traders can position themselves to ride the ensuing trends. Order flow analysis is another critical component of smart money concepts. This approach involves analyzing the flow of buy and sell orders in the market to gauge the intentions of institutional players. By understanding where the majority of orders are concentrated, traders can predict potential price movements and adjust their strategies to capitalize on these insights. Smart money concepts also emphasize the importance of market structure. Traders are trained to identify key support and resistance levels, trend lines, and chart patterns that indicate potential turning points in the market. By combining market structure analysis with an understanding of smart money behavior, traders can develop a comprehensive strategy for identifying high-probability trade setups. Wyckoff Method. The Wyckoff Method, developed by Richard D. Wyckoff, is another advanced trading strategy that focuses on understanding market cycles and the behavior of large institutional traders. The Wyckoff Method is based on the principles of supply and demand, and it provides a systematic approach to analyzing price action and identifying trading opportunities. The Wyckoff method consists of several key components, including the Wyckoff price cycle, the Wyckoff schematics, and the Wyckoff trading rules. The Wyckoff price cycle outlines the 4 phases of a market cycle: accumulation, markup, distribution, and markdown. By understanding these phases, traders can anticipate potential market reversals and trends. The Wyckoff schematics are graphical representations of the accumulation and distribution phases. These schematics help traders visualize the actions of smart money and identify potential entry and exit points. The Wyckoff trading rules provide guidelines for executing trades based on the principles of the Wyckoff method. One of the main advantages of the Wyckoff method is its emphasis on market psychology. By understanding the motives and actions of large institutional traders, Wyckoff traders can align their strategies with the underlying market dynamics. This approach allows for more precise and effective trading decisions, ultimately leading to improved trading performance. Elliott Wave Theory. Elliott Wave Theory, developed by Ralph Nelson Elliott, is an advanced trading strategy that focuses on identifying and predicting market trends through the analysis of wave patterns. According to Elliott wave theory, market movements follow a repetitive pattern of 5 waves in the direction of the main trend, followed by 3 corrective waves in the opposite direction. Elliott wave theory is based on the principle that market psychology and investor behavior create predictable patterns in price action. By identifying these wave patterns, traders can anticipate potential market reversals and trends. The theory also emphasizes the importance of Fibonacci ratios, which are used to determine potential price targets and retracement levels. One of the main challenges of Elliott wave theory is its complexity and subjectivity. Identifying wave patterns requires a deep understanding of market structure and price action, as well as the ability to accurately interpret the wave counts. Despite these challenges, Elliott wave theory remains a popular and widely used trading strategy among advanced traders. Order flow trading. Order flow trading is an advanced trading strategy that focuses on analyzing the flow of buy and sell orders in the market. This approach provides insights into the intentions and actions of large institutional traders, allowing for more informed trading decisions. Order flow trading involves the use of specialized tools and platforms that provide real-time data on order book activity, trade executions, and volume. By analyzing this data, traders can identify key levels of support and resistance, potential breakout points, and areas of high liquidity. One of the main advantages of order flow trading is its ability to provide a real-time view of market sentiment and supply-demand dynamics. This approach allows traders to react quickly to changes in market conditions and capitalize on short-term trading opportunities. Order flow trading requires a high level of expertise and experience, as well as access to advanced trading tools and platforms. Traders need to be able to interpret the data accurately and make quick decisions based on the information provided. Market profile and volume profile. Market profile and volume profile are advanced trading techniques that provide a visual representation of price distribution and volume activity over a specific time period. These tools help traders identify key levels of support and resistance, as well as potential areas of price acceptance and rejection. Market profile uses a time price opportunity (TPO) chart to display the distribution of price over time. This chart provides insights into market structure, trends, and potential reversal points. Volume profile, on the other hand, focuses on the distribution of volume at different price levels. By analyzing volume activity, traders can identify areas of high liquidity and potential trading opportunities. Both market profile and volume profile are valuable tools for advanced traders, as they provide a detailed view of market activity and help identify potential trading opportunities. These tools can be used in conjunction with other technical analysis techniques to develop a comprehensive trading strategy. Basic and popular method, support and resistance. While advanced trading concepts provide a deeper understanding of market dynamics, some traders prefer to stick with the basics, such as the support and resistance method. This popular approach involves identifying key levels where the price tends to reverse or consolidate. Support is a price level where a downtrend can be expected to pause due to a concentration of buying interest. Resistance, on the other hand, is a price level where an uptrend can be expected to pause due to a concentration of selling interest. The support and resistance method is simple yet effective, and it is widely used by traders of all experience levels. By buying at support and selling at resistance, traders can capitalize on the predictable behavior of price action around these key levels. This method can be enhanced by combining it with other technical indicators, such as moving averages and oscillators, to confirm potential trade setups. Conclusion. In conclusion, trading in the Forex market offers a variety of strategies, ranging from simple methods like support and resistance to advanced concepts such as ICT, smart money, Wyckoff method, Elliott wave theory, order flow trading, and market profile and volume profile. Each of these strategies provides unique insights and approaches to understanding market dynamics and making informed trading decisions. Whether you choose to use simple concepts like support and resistance or delve into advanced strategies like ICT and smart money, the key to successful trading lies in continuous learning and adaptation. Many traders have found success with basic methods, while others excel with more sophisticated approaches. It is essential to experiment with different strategies, refine your techniques, and stick with whatever makes you money. By mastering these advanced concepts and integrating them into your trading plan, you can navigate the Forex market with greater confidence and achieve your trading goals. Happy trading, and may your journey in mastering these trading concepts lead to more insightful and successful trading experiences. In conclusion, trading in the Forex market offers a variety of strategies, ranging from simple methods like support and resistance to advanced concepts such as ICT, smart money, Wyckoff method, Elliott wave theory, order flow trading, and market profile and volume profile. Each of these strategies provides unique insights and approaches to understanding market dynamics and making informed trading decisions. Whether you choose to use simple concepts like support and resistance or delve into advanced strategies like ICT and smart money, the key to successful trading lies in continuous learning and adaptation. Many traders have found success with basic methods, while others excel with more sophisticated approaches. It is essential to experiment with different strategies, refine your techniques, and stick with whatever makes you money. By mastering these advanced concepts and integrating them into your trading plan, you can navigate the Forex market with greater confidence and achieve your trading goals. Happy trading, and may your journey in mastering these trading concepts lead to more insightful and successful trading experiences. In conclusion, trading in the Forex market offers a variety of strategies, ranging from simple methods like support and resistance to advanced concepts such as ICT, smart money, Wyckoff method, Elliott wave theory, order flow trading, and market profile and volume profile. Each of these strategies provides unique insights and approaches to understanding market dynamics and making informed trading decisions. Whether you choose to use simple concepts like support and resistance or delve into advanced strategies like ICT and smart money, the key to successful trading lies in continuous learning and adaptation. Many traders have found success with basic methods, while others excel with more sophisticated approaches. It is essential to experiment with different strategies, refine your techniques, and stick with whatever makes you money. By mastering these advanced concepts and integrating them into your trading plan, you can navigate the Forex market with greater confidence and achieve your trading goals. Happy trading, and may your journey in mastering these trading concepts lead to more insightful and successful trading experiences. In the previous topic, we learned about various trading concepts such as ICT, SMC, and other advanced strategies. Now, we will explore different types of traders who hold positions ranging from minutes to even months. In this topic, we'll learn more about scalpers, swing traders, and day traders. Trading in the Forex market offers a variety of approaches, each catering to different types of traders and their unique preferences. Among the most popular trading styles are scalping, day trading, and swing trading. These methods vary significantly in terms of time commitment, risk tolerance, and trading strategies. In this comprehensive guide, we will delve into the intricacies of each trading style, exploring how they work, their advantages and disadvantages, and the psychological attributes required to succeed in each. Before diving into the specific trading styles, it's essential to understand that each approach suits different personality types and lifestyle choices. The Forex market operates 24 hours a day, 5 days a week, providing ample opportunities for traders to execute their strategies. The choice between scalping, day trading, and swing trading often depends on a trader's availability, risk appetite, and overall trading goals. Let's explore these trading styles in more detail. Scalping, quick profits in high-frequency trading. Scalping is a high-intensity trading style that focuses on making numerous trades within a single day to capitalize on small price movements. Scalpers aim to profit from the bid-ask spread and minimal price fluctuations, entering and exiting trades within minutes or even seconds. This trading style requires a trader to be highly alert, decisive, and disciplined, as the opportunities for profit are fleeting and demand quick action. Scalping involves using technical analysis to identify short-term price patterns and trends. Traders often rely on indicators like moving averages, Bollinger Bands, and stochastic oscillators to make swift decisions. Due to the rapid nature of this style, scalpers typically use lower time frames, such as 1-minute or 5-minute charts, to spot potential entry and exit points. A successful scalper needs to have a deep understanding of market mechanics and the ability to stay focused under pressure. One of the key advantages of scalping is the reduced exposure to market risk. Since trades are held for such short periods, the impact of adverse market movements is minimized. However, this also means that the potential for large profits from individual trades is limited, requiring a high trade frequency to accumulate significant gains. Scalping can be stressful and mentally exhausting, making it unsuitable for everyone. Day trading, capturing daily price movements. Day trading shares some similarities with scalping, but operates on a slightly longer time frame. Day traders open and close their positions within the same trading day, avoiding overnight exposure to market risks. This style focuses on capturing the daily price movements of currency pairs and requires a keen understanding of both technical and fundamental analysis. Day traders typically use timeframes ranging from 15 minutes to 1 hour, employing various technical indicators to identify trading opportunities. Common tools include moving averages, relative strength index, RSI, and MACD, moving average convergence divergence. In addition to technical analysis, day traders often monitor economic news and events that can cause significant intraday volatility. The primary advantage of day trading is that it allows traders to capitalize on intraday market movements without the risks associated with holding positions overnight. This reduces the exposure to unexpected news or events that can occur after market hours. However, day trading requires a substantial time commitment, as traders need to constantly monitor the market and make quick decisions based on real-time data. Successful day trading demands discipline, patience, and a well-defined trading plan. Traders must be able to control their emotions and stick to their strategies, even during periods of market turbulence. The fast-paced nature of day trading can be exhilarating but also stressful, requiring a balanced approach to manage both the mental and physical demands. Swing trading, riding the market waves. Swing trading is a more relaxed trading style compared to scalping and day trading, focusing on capturing larger price movements over several days to weeks. Swing traders aim to profit from market swings or trends, entering trades at the beginning of a trend and exiting before it reverses. This style combines elements of both technical and fundamental analysis to identify potential trading opportunities. Swing traders use higher time frames such as daily or weekly charts to analyze market trends and patterns. Key technical tools include trendlines, Fibonacci retracement levels, and chart patterns like head and shoulders or double tops bottoms. Fundamental analysis also plays a significant role in swing trading, as traders consider economic data, corporate earnings, and geopolitical events that can impact market sentiment. One of the main advantages of swing trading is the reduced time commitment compared to scalping and day trading. Since trades are held for longer periods, traders do not need to constantly monitor the market, allowing them to balance trading with other activities. Additionally, swing trading offers the potential for significant profits from larger price movements, while also providing more time to analyze and plan trades. However, swing trading also comes with its own set of risks. Holding positions overnight exposes traders to potential market gaps and unexpected news that can lead to substantial price movements. Effective risk management is crucial, with swing traders often using stop-loss orders and position sizing to mitigate these risks. Successful swing trading requires patience, discipline, and a long-term perspective. Traders must be able to withstand short-term market fluctuations and remain focused on the overall trend. By combining technical and fundamental analysis, swing traders can identify high-probability trading opportunities and achieve consistent results over time. So, in conclusion, scalping, day trading, and swing trading each offer unique advantages and challenges, catering to different types of traders and their specific needs. Scalping demands quick decision-making and a high level of concentration, making it suitable for those who thrive in fast-paced environments. Day trading requires a balance of technical and fundamental analysis, with a focus on capturing intraday price movements. Swing trading offers a more relaxed approach, allowing traders to ride market trends over extended periods. Choosing the right trading style depends on various factors, including risk tolerance, time availability, and personal preferences. Regardless of the chosen style, successful trading requires a solid understanding of market mechanics, effective risk management, and a disciplined approach to executing trades. By mastering these elements, traders can navigate the Forex market with confidence and achieve their trading goals. Each trading style presents its own set of opportunities and risks, and there is no one-size-fits-all approach. Aspiring traders should experiment with different styles, refine their strategies, and continuously learn from their experiences to find the best fit for their individual trading journey. In this lesson, we have explored a comprehensive range of trading concepts and techniques that are crucial for navigating the Forex market effectively. We began by delving into the use of various technical indicators such as RSI and MACD, which play a pivotal role in analyzing market conditions and making informed trading decisions. We also covered essential aspects of technical analysis, including how to interpret charts and read candlestick patterns to identify potential trading opportunities. Furthermore, we examined several key concepts, including break of structure, BOS, and change of character, CHOCH, as well as the importance of fair value gaps and liquidity in understanding market dynamics. These concepts provide a deeper insight into market behavior and help in strategizing trades with greater precision. In addition to these foundational elements, we explore different trading methods such as ICT and smart money concepts, SMC, which offer advanced approaches to analyzing and trading the Forex market. We also covered the various types of traders, from scalpers who make quick, frequent trades to day traders who capitalize on intraday movements and swing traders who hold positions for several days to weeks. By integrating all these components, you now have a well-rounded understanding of both the tools and strategies available to Forex traders. This knowledge equips you to approach the market with confidence, apply the techniques that best suit your trading style, and continuously refine your strategy to achieve your trading goals. I hope you have listened to what I said in this awfully long lesson. All right, so for this lesson, I will see you in the next one.